A new month, but the same uncertainty. As we started the trading day on this Thursday and this first trading session of September, we're seeing some weakness for North American stocks. For the TSX, which is down another 185 points, almost 1% out the gate. Really not a lot of interest in buying any sector outside of a few safety plays. And we mentioned a couple of individual stocks like Turquoise Hill popping on that deal-related news. And we started this hour by talking about this laundry list of uncertainties, whether it's the situation playing out in China and the ongoing COVID lockdowns, which is the fresh concern today, or the concern that we've had for this last week, plus the reiteration from central banks like the U.S. Federal Reserve about how aggressive they'll be in their fight against inflation. And as we talked about earlier, we've got another decision on rates from our Bank of Canada in less than a week's time. Let's talk about all of it. Michelle Schneider is Managing Director at Market Gauge Group, and she joins us now. Mish, nice to have you with us. Welcome to September. Happy September. What's on your mind as we start September?
Well, of course, everybody is terrified of this month because historically we've seen catastrophic happenings. From the mortgage crisis in 2008, there was a big liquidity crunch in 1987, and 2000, the dot-com bubble. So everybody's wondering what is going to really make this thing go down much further than what it is right now. And of course, you just laid out all of the different headwinds that we have. But I still maintain that this may not necessarily be the disaster that we've seen in years past. Housing markets come off, but it certainly doesn't look like it's in any particular bubble. Labor markets actually relatively strong, bracing for layoffs, and yet jobless claims came in lower than expected today. So I think what we have right now is a situation where we're having a slow erosion, and we have support on the way down after we had that big bear market rally. And it's really going to be a matter of how oversold do we get? People say, okay, fine, all the worst is in the market, and we may have some reasons to be somewhat optimistic for the future.
Well, and we'll watch that jobs report in the United States tomorrow. But, you know, something that some of our guests have said recently that has stuck with me is that the central banks are paying the price for what felt perhaps like too much focus on jobs coming into this year and maybe not enough focus on the inflation story, or I guess now the inflation monster. And to assume that inflation is all they are thinking about right now behind closed doors might not be the right way to think about it, because they still want to balance on the job side as well. Their language is pretty forceful right now. But for people who think that these central banks are looking to just crush the economy and the market getting really unsettled about interest rates driving higher as the economy cools and cools and cools, maybe that doesn't fully tell us how things will play out over the next year.
Well, absolutely. This is exactly what happened. The Fed was well behind the eight ball in terms of dealing with inflation when it was obvious. I know, John, you and I have been talking now for quite some time about that. And now it seems like they've stretched the rubber band too far the other way, as oil prices are dropping and metal prices are dropping, and a lot of consumer discretionary goods that were more on the inflation side have also dropped. But Powell did say that he would be looking at the data points in terms of the overall market. And we know he's probably focused on labor, and he's also focused on the housing market. So we'll see. Today kind of shows that the labor market is still steady. So I don't see that we're going to see any kind of pivot anytime soon. But clearly, if we start to see reports like what we had out of NVIDIA, which is not just inflation-driven or interest rate-driven, although that's an impact, but also China-driven, and more reports of companies really struggling under the current environment, even if they can't find workers to fill the jobs. I would imagine that it would behoove the Federal Reserve to not be the devils. They were the devils on inflation. Do they want to be the devils in driving us into a deep recession?
Yeah, and to your point, you always come to the table, Mish, with some investing ideas. We'll show those to our audience now. A lot of these companies that you're highlighting today are names that investors have shied away from in a big way this year. Some of them are technology. One of them's tied to China. And then in this country, outside of the weakness we've seen for technology, we've seen the cannabis companies just get absolutely crushed. But you've got one, Tilray, on your list. How come?
Well, in terms of the other picks that I have, in terms of China, right. I mean, this COVID situation just keeps coming up and coming up, coming up. And I think at some point that will go away. And that's why we chose Milko, because Milko is tied to Macau. And at some point, as part of the culture, I think that would start to be a place where we would start to see opportunity opening up. And that stock really is related to that. But all of my picks, by the way, and including the one on cannabis, is because of the risk factor. Right now, if you want to get into anything, and we'll talk about the Tilray in a moment, but if you want to get into anything, your risk is going to be the most tantamount thing to consider. So we always have stops. So with Tilray, for example, it bottomed out at around $3, but you have had some positives. Number one is it is a commodity in essence tied to water. California has had huge water problems, and even though we still are going to have major legislation issues with Congress getting any kind of interbanking passed, we still have 1 in 6 Americans were just surveyed as doing cannabis now, whether it's medical or recreational. It has the potential for a huge industry. In fact, I'm almost shocked that the United States hasn't figured that out yet. Billions and billions of dollars of tax revenue that can come in, not to mention just, tourism money and manufacturing, sales, et cetera, et cetera. So I think that if you can risk, $1 to sit with it, great. I don't know how much more downside it has. And I do believe if we do get worse and worse in terms of closer to recession, typically people go to things that make them feel better, whether it's alcohol or in this case now more cannabis.